Okay, thank you. So, yeah, real interesting ways to get these deals going. So the capital markets are in a weird place right now. Debt is expensive. Debt is questionable. People are lending, people are not lending. Stuff's floating all over the place before it closes. A lot of debt. And Alex and I were speaking about this yesterday or over the weekend sometime, how it's almost like the Wild West in the debt markets, right, Alex? So as loans are working their way towards closing, they don't even fully know where the rate's going to be until closing, and it's bouncing all over the place.
Yeah, that's correct. I mean, for better or worse, right now when you're bringing a deal to a lender and, they like the terms, they like the asset, they like the profile of the asset, they like you as a sponsor, historically that's been a big win. And you can really lean on them and know where it's going to shake out. Right now, with obviously what's happened just really in the past 7 days, that interest rate and overall terms is moving daily. Just because of what's going on right now. And it's making it very difficult for sponsors to really pin down what interest rate and loan amount they're going to end up settling on, which, sure, if it's just an 8-unit property for yourself, maybe doesn't have as large of impact, but working on larger deals, larger loan amounts, equity commitments, investors, it really is becoming difficult. So we really will see, Wednesday, the Federal Reserve will meet again. We'll see where they go on rate hikes. A lot of people are saying slowing this down to 25 basis points. A lot of people are saying potentially a pause, but that will also have a real meaningful impact on what's going on in the debt market and how people will finance things going forward.
Hey, so I'm just gonna say something. So we have an unexpected guest here, Anthony Schaefer. Anthony, I'm gonna unmute you. You could unmute yourself, actually. I'm gonna allow you to unmute yourself. If you want to jump in with anything we have to say. Anthony is the owner of Icon Realty Capital and Icon Equity Group. We do some projects together. He got the email, jumped on. Thanks for jumping on, bud. Like I said, if you're listening to this, you could at any time jump in and talk. Anthony is very knowledgeable in the lending world, and his main squeeze, in case anyone's interested, his main squeeze is rescue capital. So they're there to save you. They're there to save you when something may go wrong. So, okay, guys, thanks for joining. Like I said, this is going to be the Zoom about ways to finance these deals. I'm going to share a screen. We put a small PowerPoint together just for some visuals, and we'll go through some hot topics in the debt world when it comes to financing, specifically multifamily. This is going to be specifically multifamily focused. So you'll see some things that we see, some things that we look for. And one of the most important things to focus on, we believe, and you'll see it here in the presentation, let me get sharing in a second, is you need to understand the current condition of the property and the current condition of where the seller is. And that will determine usually a course of action of where or what you could do as far as financing is concerned with the property. So let me bring up this PowerPoint. You'll see what I'm talking about, and we'll hit a couple high topics, and we'll get a little granular if you want. Questions are always welcome. And give me 1 second here, and I'll pull it up. Okay, so Alex, you're able to see this, right?
Yep, I see it.
Cool. So what's the driver behind selling the property? So you want to know you need to know what condition the property's in, or why is the guy selling? Why is the company, the group, or whoever owns it, the family member selling this property? That's really going to be a big dictator of how you're going to finance this thing. And so, and the reason for this Zoom is not just to tell you, yeah, how do you finance a multifamily deal? You go to a debt broker, they give you a loan, and you move on with your life. It could get more, I wouldn't say complicated, but it could get more interesting than that. So really, real estate deals, and sometimes people will see these offers that come through and say, well, no one will ever accept that, whatever it might be. Crazy seller financing with no money down, or the most wildest thing you could think of. The wonderful part about this business, and really doing business, how about doing business in this country overall, is you could offer anything you want. You could ask anyone anything, and a lot of business in any industry is not done because people are afraid to ask. So when it comes to literally doing anything, and it comes all the way down to an offer to a property, or an offer of how to finance a deal, or ask someone something, the only thing that could happen is they say no. So like I was saying before this Zoom started, Alex and I we're getting an LOI signed. It's getting executed on the seller side as we speak. And we presented an offer that we didn't think was going to happen. And we presented an offer that made it worth it for us. We presented an offer that made it worth it for us, and it wound up working. So we actually, on that deal specifically, we tried to do some seller financing. They weren't interested. But with that being said, we got what we wanted because we asked. So it goes the same thing for presenting deals. You could ask the seller anything you want. You could ask him for any kind of terms if you wanted to get him involved, and seller financing is a wonderful way to get a deal done. And a large point is they could put themselves in a position that they don't own the property anymore, but it's still making the money. So that's why seller financing winds up being a popular thing. And the biggest way that I've had seller financing work is just ask the seller, what are you going to do with the money? So, in our world, there's a tremendous amount of money coming in. So we're buying $10+ million properties. So essentially the seller's getting a check for $10 million minus what he owed on it. What are they going to do with the money? That's a great question, because a lot of times they don't have an answer for it. If you're dealing with a sophisticated group of individuals, there's a good chance that they have something that they're going to be doing with it. But a lot of times there's no answer. So especially on the smaller things, so call it $1 to $2 million. When someone sells something, they don't really have a plan with the money. So a lot of times, even if you offer them some terms, something like, 2 or 3 year kind of situation, what it does for them is it'll allow them to spread out their tax burden on the property as well. So there's a lot of benefits to seller financing. And we really didn't get started here to just talk about seller financing, just the different ways you could get deals done. So one of the great parts about real estate is you could really put anything in front of anybody and see if they take it. And a lot of times there's a reason why they would want to take it. And we could go deeper into that in another call. But basically, the first slide here is what's a driving force behind what's a driver behind selling the property? So were they a market seller, just own the property for a while and just want to sell for whatever reason? Death, destruction, divorce. So they have to get out for one of those reasons. So they have some internal distress in their life. Or is current debt a problem? So the distress is really comprised of any of the above, right? Death, destruction, divorce, any crazy thing. Or are they in a financial problem where they know their debt's going to be a problem? So the reason that it's important to know that is usually if their current debt is going to be a problem, they're not going to be candidates for seller financing. Market seller, maybe. Death, destruction, divorce, maybe. Probably not destruction, death, maybe, divorce, maybe. Probably not divorce, actually. Divorce is a bad thing. So
How about partnerships falling apart, Chris?
partnerships falling apart. Yeah. So if a partnership is falling apart, usually they just got to get out. Or maybe one of the partners is happy, one of them is sad. So the partner that's happy would be interested in doing some kind of deal. Or actually, so actually, Anthony and his partner Mark are probably the most creative people ever when it comes to financing deals. And they do things where they'll offer to, and Anthony, you can go deeper into it if you want, but offer someone to stay in a deal where they thought they had to exit, but they really don't have to exit. And they could stay in for a certain percentage, and then we're going to take the property and we're going to do this to it. And then we're all going to make money together later on because we did this to it. So really, you could get as creative as you want. The main point of my story here is it's just not going to the bank. That's not just going to the bank is not the only way to get deals going. How long has the current owner owned the property? So it's important for you to know this because you want to know how much equity the current owner has in the deal. So if they've owned it for a very short period of time, and this is a very specific period of time, that this would be one of the few, I wouldn't say it's one of the only, but it's one of the few times in history where if you purchase a property in the last year or two, it might be worth less now than when you bought it for. So it's important to know, are these people in the position of losing money on a property, or have they owned it for a long period of time? So if you, at this point in time, if you own something for 5 years or more, is a very good chance that you may not be making as much as you would have made if you sold it a year ago, but there is a chance that you're still making enough money where there's some room to play. There's some room to do something within the realm of holding a note. And again, whenever you're going to present a seller with seller financing, and I don't want to, like I said, I don't want to do all this, but whenever you're going to present seller financing to a seller, make sure you remind them, what is he going to do with the money when you sell it? Because sometimes people aren't even thinking of it. And the second thing is, if they're set to make a good amount of money on the property, if they do a certain level of seller financing, they're only paying tax on the money that they get when they close the deal. So the money that's going to be financed is not taxable gain to them yet until they get it. So we'll allow them to spread their taxable gain out over a longer period of time, and that could be a benefit to them. So I've been involved in a deal where I did seller financing, and we told this to a seller. He said, no, thank you. And I said, go ask your accountant if what I'm saying is true. And he came back and he said he's in. So that's happened to me in the past. And the reason I keep talking about seller financing is just the way that the debt markets and the capital markets are right now. It should always be considered. Okay, so this is one other thing to notice. And this actually, so this is these three things are the three things in the last slide that I said, this is going to play into your offer as well. It's going to play into how much you're going to offer them and how you could. So in the LOI, you're going to present them with a price and then how you intend to get the deal done. So you also want to know these three things. It's very important when you're offering a price. You want to know what kind of position, again, it all goes back to, you want to know what kind of position the seller's in. So do they have floating rate debt? That's important to know. A lot of sellers got into a position where they didn't lock in. I'm sorry. They got into debt at 3%, 3.5%, and they were confident that the interest rate was not going to move over the next couple of years. And obviously that took a turn.
That's correct. Yeah, that's a great point, Chris, just because, I think a lot of people going back to 2021, they put on floating rate bridge debt, when rates were as low as they've been, and they figured, okay, I have my project budgeted. I know what I want to do here. I think I know where rates will be when I ultimately do the project, and things not only doubled, but tripled. So now not only is their entire underwriting changed because they, assumed a lower construction loan and a lower takeout loan, they now are also paying a higher monthly, interest payment on that land they're carrying. So I think one reason Chris and I have really shifted to pursuing land in very attractive core markets today, such as the Peace in Dallas, is because you are seeing land prices fall first and the quickest. So, I think a real reason of why land has become cheap is because the carrying costs are so high and people are looking to exit land they may have overpaid on. Not to say that land is by any means worthless. It's just whatever they had baked in from an underwriting and project standpoint does not work anymore. And for them to get out at par, a minimal loss or a minimal gain still can make a lot of sense, and let the next guy come in and craft his project in today's current market. So I think floating rate debt, which is how most of land is financed today, is having a material impact on availability and how sponsors are really pursuing these opportunities.
Yeah, for sure. And, understand that the opportunity has shifted in the market. Alex just brought up the fact that we're getting involved with a land deal. The opportunity has shifted away from multifamily. Multifamily right now is in a frozen position. And our opinion is, if you see a deal come across from Cushman, CBRE, any of the big boys, the guys that have the marketing ability that these guys have, you see any deal come across with their name on it, just skip it. It's going to sell for a return that it's going to sell literally for a return that you will not be able, no one on this call, or probably no one is going to be interested in getting. So it's either going to sell to an institution that typically needs far less of a return than us as syndicators, or call it younger investors need, or smaller groups need, or it's going to go to someone that's not really sure what they're doing, and they messed up on some underwriting somewhere, and they're going to realize that they shouldn't have purchased it. So a deal we were just looking at, and was it North or South Carolina?
Yeah.
It was a 60s product. It needed a ton of work. I was able to tell that 3/4 of the roof were bad. And they told me that someone's going to pay $10,000 or $15,000 more a door. We put that into our equation, knowing exactly what we're looking to get. And the deal returned like, you'd be better off going to buy a treasury and having no risk and having it sit there. So so unless you have some creative ways of snaking deals out, which really that's like in the 50 and under category. You contact anyone with 100 units or better, there would be no reason for them to sell to you. Why would they sell to you? If they wanted to sell, they would go to one of the big brokerages and market it the standard way.
Yep.
So good.
I agree, Chris. It's it gets a lot more competitive in larger unit count, and obviously, everyone on this call can probably recognize the Sun Belt market. There's no secret sauce or secret that that's where people want to deploy capital. It's the most high growth markets in this country. The lenders are attracted to it. Investors are attracted to it. They're landlord friendly states. So, as you get in that larger unit count, it really gets more and more difficult to source those deals. And kind of going back to the topic at hand, what is the seller's current debt situation? We do think this is relevant to multifamily. And I would say for everyone on the call that's underwriting and looking at deals, as you request diligence, something that has not been of interest or really a focus point the last decade is, what is their interest expense in that T12? Not every broker or seller will provide that, but it is absolutely worth a look, because in most cases, and what Chris and I have seen on some deals that end up being a little bit more attractive than others, is you see that monthly interest expense right below the NOI getting larger and larger month over month. You actually see, wow, his interest expense was 24,000. Now it's 36,000. He most likely did not project that. And that number, that's not accretive CapEx. He's not putting that into appliances. He's not paying his staff well. That is truly just his interest payment being where the market is. So, even though we're talking a lot about land and what that situation could be, it is more relevant than it ever has been on multifamily. So if you can pick up on the T12, that could be a real competitive advantage of how bad is this seller sweating, and do they really need to sell the property?
Yeah, and you'll see just some terms that we use very lightly all the time. And sometimes I like to remind myself there was a period of time where I didn't understand what any of these terms meant. So I typed this PDF up quickly. We could obviously go more in depth, but floating rate debt, so we just spoke about that. That means their interest rate is moving as time goes on. And a lot of people counted on interest rates not moving. So like Alex said, their loan payment could have been 25,000. Now it's 35,000, 45, 55,000. They did not expect that to happen. So that it's basically they're hitting the panic button saying they have to get out. So there is plenty of real estate out there that it's great real estate, really, truly great real estate. It just has bad debt on it, or was purchased at a bad basis. Needs someone new to come in. You change the basis, which is the price they paid, or you change the debt on it. And now all of a sudden it's great real estate again. Balloon payment. So balloon payment is if you have a 10-year loan that's 120 payments. The balloon payment is the 120th payment is the balance of the loan. So if you owe $20 million, $10 million, whatever you owe, your principal could be, say you have it, I don't know, I'm just throwing numbers out there. You could have $8 million left on your principal, and you have a $50,000 a month loan payment. Month 120, your bill goes from 50,000 to $8 million. It will say it right on the statement. So do they have that date approaching? The reason that's important to know, again, is what kind of shape are they in? What are they going to be looking to do? And a lot of times, if these guys are in some level of debt problem, they're not going to be interested in taking on any loan themselves. You're going to have to go outside. And then how long is left on their term? That's simple. So are they interested in, or is their loan expiring in any of the other senses? So balloon payment, rate locks. So just there's a whole bunch of things, and it all kind of goes back to what's their current situation. Let's see what we got. Okay, so this gets to the juice, and this is outside of everything we spoke about. If it is going to the bank, this is the top ways to. And Alex, I'm not sure. I probably missed a couple things here, but just basically the top ways to finance a deal. So
Yeah.
Agency, insurance companies, agency. Oh, I gotta plug in.
Yeah, no, this is a great place. And I think, again, we're really focused here on multifamily and housing. And for anyone on this call that's either pursuing a deal, looking at a smaller deal, there are some groups out there, that we've actually worked with and transacted with that more play in that $500,000 to $2 million loan size. And we're happy to not only hear about your deal, but introduce you to some of the direct relations we have at these lenders. Rock Capital, they financed a deal Chris and I did in Alabama, a 50-unit deal back in 2021. Fortunate for us then, we had the hindsight to stomach a little bit higher interest rate, but it's fixed. So, every month we are solely focused on asset management and creating the most amount of value in that asset. We are, you know, not really at all affected by the capital markets, you know, which is a good place to be right now. But again, you know, if anyone's pursuing a deal, looking at a deal, they're thinking where are interest rates right now, feel free to reach out to Chris and I. We do have some direct relationships where they'd be happy to provide you a quote, look at your project, you know, really form a relationship when things may be quiet. And that, you know, for the reason I brought that up is that may not be on this slide here, but, you know, this is a great place to be, you know, as far as the agencies, they're typically there for your stabilized product. You know, their mandate for 2023 was to do $90 billion in new origination. You know, so you hear that and you're like, wow, what does that mean? That's basically the government saying, we're going to work alongside these two agency groups to facilitate both new acquisitions and refinances on multifamily affordable housing product in this country. You know, so it just shows you, like everything else, the government is fully aware that this is a necessity, and they offer a product that helps real estate investors and operators be incentivized to purchase and really grow, you know, whatever asset they have using this financing. You know, so they've been, I mean, I can't even begin to tell you the amount of sponsors that they've helped not only create a massive portfolio, but make very strong returns for themselves and investors, both Fannie Mae and Freddie Mac. The insurance companies, I truly think these groups are overlooked. And the way these work is Aetna, you know, you may have your medical card in your wallet, says Aetna, they're an insurance company. So they are collecting the premiums monthly. Them, more different than an investment platform, they need to lend out that money to generate some type of return. And again, the life insurance companies, they're more conservative by nature. So they're going to be there for your lower leverage, call it 55 to 65% leverage, and they're going to be fixed rate. So Chris and I have actually done 2 loans with Aetna in the last 6 months, one being 5.3 million and the other being $6 million. Both of them fixed rate, 65% LTC, 5-year terms, have interest only within the loan structure. And the life insurance companies, they do take some vetting and time to get the opportunity to work with them. And they're not going to go into every project, but they have been a very overlooked source of financing the last 6 months. You know, typically people were shying away from them because they were lower leverage, fixed rate had been higher for so long. They quickly became one of the lead horses in really financing multifamily across the board. So Chris and I are fortunate to have them as a strategic partner on 2 of our deals currently. And, you know, typically the way to think about them is sub 65% leverage, but fixed rate.
Yeah.
Go ahead, Chris.
I guess the reason that the insurance companies are interested, or they're back part of the game, is they lend their own money. So when the agencies are lending it, you know, 3% or even sub 3%, the insurance companies, they balance sheet the loan, which means that it's their own money that they're putting out. It's not as attractive for them to put their money into something that's getting sub 3%. Is that correct, Alex? And
That is correct. Yep. Yeah, they're able to generate, you know, an above average return with those premiums. So, you know, they're not going out there trying to hit home runs. They're just hitting singles and doubles with their capital.
Mhm.
And, you know, us as real estate investors and sponsors are able to reap the benefits of that.
Yeah. Anthony, what are you seeing out there in the markets, the capital markets?
Let me unmute myself. You guys hear me?
Yeah.
All right. Sorry, I switched from the car to the computer while we were mid-call.
Yeah.
I'd like to touch on a few points if you don't mind.
Yeah, go for it.
local banks, the smaller, not even the regionals, but the small ones, depending on where you are, usually have an appetite for local lending, especially if it works and fits into their CRA book.
Yeah.
They're going to be a great resource. Credit unions, they're another great resource I don't see on here, but for those deals that are in that $1 to $10 million range, you can find a lot of money out there where it's attractive. It doesn't approach the agency levels of leverage. However, it will put you in a good spot if you have enough equity in a deal. So I like them as well. We always go to those first when we're looking at local financing for a property. If I'm going to be in West Palm Beach, I'll look at like the 5 local banks, like a Legacy, or I don't know where you guys are, but an Amboy Bank in New Jersey was a good one for a while. Connect One before they changed their name. I don't know who they are anymore, but they were always a good resource as well on top of these. Timeline when you're financing with some of these places, agency debt, insurance company debt. The agency debt usually takes longer, especially if you're getting like a HUD loan. Those are like 9 months or something to underwrite. It takes forever. So just make sure you have enough runway to get those things done. Those are some of the points I always like to look at. And as Chris said, when you're underwriting your deals, always underwrite with an extra 100 basis points on the exit at a minimum. That way you don't get caught where you don't have enough equity or you just don't have the cash flows to escape your own project.
Yeah, so that's a great point, Anthony. So that's the exit cap rate. So where you think your cap rate's gonna be when you exit, that's one of the biggest movers on underwriting. If you bought a deal at a 4 cap and you put in a 4 cap as an exit in 5 years or 6 years from when you got that project, go to that same underwriting and plug in a 6 cap and see what it does to the returns. It's an astronomical mover. So if you change the interest rate, so say if your interest rate's at 6% and you put 7 or 5 and then 6, it really, over the course of the investment, as long as you know when you're getting into it, if you change that, it doesn't really maneuver the returns as much as you might think. So buy-in interest rate doesn't maneuver it when it moves dramatically over the course of your investment without being planned. That's one single problem. But when you're getting into it and you're looking between a 6 or a 6.5% interest rate, it maneuvers the returns. It does, but an exit cap rate is like one of the biggest movers. So that's a great point, Anthony. It's probably one of the biggest movers on underwriting. Did you have any others? Because those great local banks, that specifically local banks is specific to a market, it's a huge thing. And actually, yeah. Alex, you've mentioned that as well in the past. The local guys.
I completely agree with that. He makes a great point. Especially in the tri-state, these groups can be very relied on. They know the market. They probably lent on similar projects. So, not the easiest when you're looking at a deal in, the suburbs of Atlanta or the suburbs of Nashville, but you will find those local and regional banks that have an appetite for that. I mean, it's probably couldn't be a more interesting time to speak on what's going on in the regional bank sector right now. I'm sure people have seen the headlines with Signature Bank and what happened there. Looks like New York Community Bank is actually picking them up and buying the bank. But yes, the local and regional banks have been a great financing solution. Typically will offer a fixed rate product and could be a little bit easier to work with. The CMBS space, I would say, is more geared towards retail, office, industrial, self-storage. I've seen people finance multi, but historically there's been better alternatives. And, when you talk about a strenuous closing and diligence and loan doc, that's CMBS. So, not to say there's not a need for it, because if it fits the box of CMBS, it probably is the best debt, but I wouldn't put that as your primary option for multifamily. And I probably wouldn't let anyone tell you that.
Yeah, I have zero experience with CMBS. It's commercial mortgage-backed securities. Alex Alex has great experience with it, and I'm sure Anthony knows CMBS, or at least the mechanics of it fairly well as well. So that would be, I guess, Alex, would you say, or would you say we covered most of the largest, and seller financing we covered before we even got here? So seller
Yeah.
financing it's basically whatever you want, whatever you're able to get the seller to agree to.
Hey, Chris,
Yeah,
one last point. I'm sorry, Alex. didn't
Yeah,
mean to-
go for it.
No, go for it.
When you're starting to consider your perm financing with any bank, it's a great idea to talk to the banker about how they do valuation. It's very important because you can go to some banks and they're going to hire whoever comes up first on their list, and you end up with, Ted's Used Cars and Appraisals doing your 10 million deal. And you
Yeah.
some of the stuff you end up seeing, if they're not using a top 6 valuation firm, you don't know what you're going to get. You're going to have a 10 to 12% variation on your values.
Yeah, it's like your plumber doing your electric work.
Yeah.
Yeah,
No,
that's a great point.
That's a great point, especially, the appraisal process, depending who you go to, that process can be very stringent. Some groups, which the only type of financing that really comes to mind that's not on here would be bridge. When you see a multifamily operator or was buying something at a 3 cap and it needs a value add component, you're going to renovate 30 to 60% of the units, you'll get a short-term bridge loan. So basically, when you acquire an asset that way, you're taking on a 3-year loan that's typically a bit higher leverage. It's probably an interest-only loan, so your monthly payment is going to be less, given you're not paying the loan balance down at all. And really what you're banking on, and historically has proven out, is you're going to get both rent growth and NOI growth, that within that 3-year period, you will then be able to refinance the asset at a higher valuation, and at a minimum pay off the existing acquisition loan. So the purpose really of these bridge loans is if you feel like you have a value add play here, and you think in a very short period of time, your asset's going to be worth more than it is today, and then you can go to the agency, regional bank, or insurance company debt to take you out. That's really where a lot of these large cash out refinances have taken place as well. So bridge lenders, they've been a huge part of the real estate finance industry for a while now. There's several in New York that we're aware of, we worked with, they'll quote our deals. We're happy to share those intros as well. And, people can get some good context of where they're pricing things today, how it'll be on leverage, things like that. But the bridge source has been a great way to get into permanent loans.
Yeah. So, and Alex, thank you for bringing up the bridge option. Bridge is it. So this is understanding bridge there's a good, and this is when it gets into understanding the terms of the loan and all the lingo that goes with it. Debt service coverage ratio. So the banks want to know how much of that loan payment can you cover with the amount of money that comes in the door from the asset. So typically agency, insurance company, I'm sure CMBS, seller financing, you usually, again, that could be played with any way you want. But typically when you're going to a bank, they want to make sure that the NOI of the property, the net operating income, is able to handle 120% of the loan payment. So that would be a 1.2 debt service coverage ratio. When you get a bridge loan, that means you're buying a property that cannot cover 1.2%. Maybe it could only cover 100%. So meaning that your loan payments are going to total out to be, I don't know, $100,000 a year. It'll be much more than that if you're dealing with if you're playing with the larger multifamily stuff. But if your property is bringing in $100,000 a year and your total debt service is going to be $100,000 a year, that would basically be a 1 debt service cover. Your debt service coverage ratio will be 1. That would be a candidate for a bridge loan. because what you're doing is you're buying an asset that can't really sustain the debt, but you're going to the bridge lender with a plan of how we're going to be able to get this asset to levels that will perform at a 1.2 or higher debt service coverage ratio. So they know that the bridge guys know that you're not going to get into them and be into them forever. The bridge guys are interested in being with you for a year or two or 3 or 4, and then they're out. You don't see bridge loan, 10-year bridge loans. So, and the reason you wouldn't want a 10-year bridge loan is the interest rate is typically much higher. So Anthony, actually, that's, and Anthony, correct me if I'm wrong, but that's in your Icon business, your main business is bridge lending, short-term bridge lending. Oh, he had to pick up a call.
Yeah.
Yeah.
No,
So
it's very common. You know, Chris, we've spoken, even that group out of Atlanta that was interested in investing in the last deal we did. They have both capital they raised to deploy into equity as well as debt, because both of them are, you know, could provide good risk-adjusted returns. So you do see a lot of platforms that do both. You know, you have Blackstone, no secret. They have their Breads debt business. Oxford, the largest pension fund out of Canada, they have their equity and debt business. CIM, one of the largest developers in the country, they have a very large equity and a very large debt business. It's really no secret. And the more and more institutional players are getting in this. I mean, now that I'm speaking about it, Starwood, they have a huge mortgage REIT where they do a ton of lending. And really for them, you know, they feel like they understand a lot of these markets and the fundamentals from their equity portfolio that they can step in and be a lender. Yeah, they're not the cheapest capital by any means, but yes, these bridge lending platforms have grown. There's been a ton of new players that got into the space in the last 5 years, but they, as Chris mentioned, are not your permanent financing solution.
yeah, so there's a question in the chat. It's actually good, and then we'll go over. I have a loan matrix it's a sample loan matrix that we put together. We had our debt broker put together for a deal that we actually did and closed already. I'll show you that what a loan matrix looks like when they send it over to you and what to look for on it. But Hunter asked the question. This is a great question. So he's looking at a 68 unit rental property, 1.75 million, assumable at 3.6%. Asking price is 3.4 million. Started at 4 in November. Sounds typical. Do I have to raise the difference, or could I get agency debt as well? So agencies, insurance companies, any of the big boys, for the most part, do not want to be in what they call second position. So second position means they're the second to get paid in the case of a default. So in the debt world, everyone's in order. So it's a straight line, and the guy who's sitting in the front of the line gets paid first in the case of a default. And everyone wants to be in that seat. So the reason is, if the property sells in the case of a default, if they have to sell a property, the debt people want to be the first to get paid. They don't want to have someone else get paid and then they're sitting behind them. There is reasons why you would put someone in the second position, but Alex, correct me if I'm wrong, but Fannie and Freddie, they don't want to be in a second position unless I believe they're in second position to themselves, which in that case would just be a supplemental.
Yeah, there's opportunities to do supplemental. I think, to be honest, on that loan size, it's a little small to have the supplemental program step in. You know, the unfortunate is it probably means more equity coming to the table. And what I would say on the assumable loan, which Hunter, I'm sure you've considered this or given it a look, is you want to understand the term of that loan. You may not want to assume that loan if you're stuck in that loan for the next 8 years. Because on the agency loans, if you wake up tomorrow and the property tripled in value, you can sell it, but in some instances, you're going to owe the interest that you would have paid for the foreseeable future to the lender, which could be tens and hundreds of thousands of dollars. So I personally think that assumable debt is great, but you absolutely need to understand the prepayment and term of that loan. Just to make sure you're not locking yourself into something that it just may not make sense.
And Hunter, actually, thank you for bringing up, I completely left it out. Assuming a loan. A lot of properties trying to be sold on assumable debt right now. Why is that? Because no less than 1 year ago, or no more than 1 year ago, debt was very attractive. So there's a lot of debt floating around, and it's probably almost every single family house in the market is locked up with very good debt. So, internally, this is why we don't think there's going to be a housing crisis, because most of the housing in this country is locked up with low interest, long-term fixed debt. So everyone's mortgage payment relatively is fairly low right now. Going forward, mortgage payments, new deals that are closing, the mortgage payments are much higher. So there's a lot of and separately, there's a whole way to acquire single family with assumed debt, subject to loans. That's the whole other topic. So there's a whole bunch of deals out there trying to be sold with assumable debt. And when we internally look at deals that have assumable debt on them, we actually ignore the fact that we could assume the debt and we underwrite it with new debt on it. And if it works, which they'll usually be somewhat a step into our place and take the deal with assumable debt as it sits. Internally, we're not overly obsessed with that, because the only thing you can't change when you buy a property is the price you paid for it. That is literally the only thing that you cannot change. So when people are buying property with assumable debt on it, they're paying a higher basis than if they were to buy it with new debt. So they're not taking advantage of the rule in real estate that you make your money when you buy. So they're paying a higher price because they're buying it basically at yesterday's price when they're buying it with assumable debt. But if we were to buy a deal with assumable debt, we would go backwards. We would underwrite it as if we were putting brand new debt on it, and we would then give it a little bit of credit on the back end that we're getting it with good debt for a short period of time. Because usually the loan we're going to get it with, if we were to assume a loan, would save us money for a couple years, usually. Multifamily, usually the loans aren't, the loans are not forever. There's a term on most all loans. So if we were going to get a deal with assumable debt, we would go backwards. We would underwrite it, and we'd want to pay as if we were putting new debt on it. And then we would just give it a little bit of credit as, say, other income or something. Money that we're saving on the monthly payment for the period of time that we're saving it. And that's because we want to make sure that we're paying where our basis is correct. So that's important to know when you're getting into fixed debt, assumable debt. You don't want to just jump for those and pay yesterday's price today. So this is a typical loan matrix. This is what your debt, this is what our debt broker would send us when we're looking for debt. So a couple things that's important to know, and you'll see some terms on here, and it's important to just understand what they're really talking with. And as complicated as these loans could be, and as long as the term sheets could be, this is basically what it comes down to. So loan option, you'll just see some you'll see some terms here. Life Co, we went through that. That's life insurance companies that you would know every day. MetLife. MetLife will be, I don't know, Alex, where's MetLife starting? $20-30 million loans?
Yeah, that's correct. So, if we're looking at the first row here, all the way on the left, this is Aetna, for example, just full transparency. MetLife you know, obviously a mega insurance company, if not maybe the largest in this country, they're more doing the $25 million loan size, you know, the beautiful Class A apartment building in the downtown area of Phoenix or Austin. They're financing that. But yeah, you know, this is Aetna here. And a few areas to really focus on here is the estimated interest rate here is 6. And as people go, you know, the interest rate 6. Last week I tried to buy a home and my mortgage broker quoted me 6.8. What is this driving off of? And that's where I think you focus on the estimated index rate, which here is 4.23. What the index rate is that is what it's priced off of. Typically, it's going to be the 5, 7, or 10-year treasury, which if you Google that at any given time, you will see where that rate is on a daily basis. So as that goes up, it's no secret your interest rate does as well. And then that spread of 180, that's just the mechanism of the lender pricing the risk and part of their profit for doing the loan. So, you know, sometimes spreads will come in, and when someone says that means spreads will get lower as rates get higher, because as that index rate goes up, which none of us have control over, and nor do the lenders, that interest rate just becomes unable to be stomachable. So spreads actually have come in over the last 12 months, and that's how you're getting to that all-in 6.03, 6% interest rate. You know, so a lot of people ask, you know, what are interest rates derived off of? Most of the fixed rate product is truly based off of the treasury market. On those bridge loans, those that are floating rate, they are priced over SOFR. And SOFR is what everyone has been focusing on and obsessing over when Jerome Powell gets up and speaks about raising the federal funds rate. So that rate has been going up drastically over the last 12 months. And that is the risk of borrowing floating rate debt. Obviously, on Wednesday, when we all tune in and you're looking at your stocks and what's going up, down, that's truly where you see him make the decision, or, you know, the collective committee, and that will affect those interest rates. But nothing on this matrix, I believe, is floating rate, which would be based off of the SOFR index.
Yeah, so, and that's great insight for people just to understand how the bottom interest rate, how they get to that number. So like Alex said, the index rate is basically what it would be they're borrowing the money at. Then the spread is what they want to make on that money. And then those two total together would be what you're paying. And then you'll see a line here, minimum DCR, debt coverage ratio. I spoke about that earlier. So that is how much they want your deal to be able to cover the loan payment. So you'll see in the first one, Life Co., they want you to be able to cover 125% or 1.25 times how much money the deal makes. Yeah, I think I said that right. 125%. They want the deal to make 125% of what the debt's going to cost. And across the board, you'll see every different lender wants something different. And if you come all the way down here to the end, and Alex, are you able to see my pointer?
I have my chat up, so I actually, I don't see it. Oh,
okay.
Yep, I see it. I see it. Sorry, the
Okay, cool.
participants was covering it.
Okay. So if you see, let's see if I can move this. I could actually bring up a laser pointer. Look at that. So if you go all the way down to bridge, this is what I was talking about earlier. You'll see 1 here. So that these are the guys who are here if you can't cover 125 or 130% of the loan payment. The bridge guys come in and say, all right, if you could just pay us and not make any money, we'll give you a loan. but it's only going to be a 3-year term. And then they're talking about renovated rents here. And so these guys come in and they say, okay, you have a plan, let's hear it. We want to make sure that when you buy this thing, you're able to cover at least what we cost you. And we're going to charge you a higher interest rate. And we want to get out in a couple of years. We're going to make our money. You're going to be able to get the deal. And when we go, then you're going to come into one of these perm. So it actually says perm, and over here, bridge. So like I said, these loans, these you're going to get a loan doc that's going to be many pages long, but it basically all lies right here. Non-recourse means you're not responsible for the loan if it goes bad. So there's non-recourse standard carve-outs, which means if you can't pay the loan, they can't come after you personally. But of course, that's not 100% the truth. There will be reasons, carve-outs, of why they can come after you. And it's usually based upon some level of fraud or misrepresentation that they would be able to come after you. There are some loans where you'll see recourse, and a lot of times the interest rate will be less, but you don't really want to take that risk. It's not worth it to take recourse debt at a lower interest rate usually, because then what happens is when you take recourse debt, they're completely in the driver's seat. They're basically, it's their way or the highway. When it's non-recourse and you owe them enough money, there could be a negotiation if something were to go not the way that it's supposed to. So you want to put yourself in the position that you're at non-recourse. And it's not so you don't have to pay them. It's just so it puts you a little bit more in the driver's seat if things don't go the way you want. Let's see. So term, that's obvious. That's how long the debt's going to be for. Rate type, fixed. It'll either say fixed or floating here. Amortization. So when it passes the interest only period, this is what your payment is going to be calculated on. So when you see 30-year amortization, that does not mean you have a 30-year loan. The loan term is here. It's just what they're going to calculate your payment on. So a 5-year term, so month 60, that loan is due, but they calculated it as if the loan was going to be for 30 years. DCR, we covered that. Loan amount is obvious. And then prepayment schedule is probably one of the more important things we look at. So when we put our deals together, the interest rate is looked at a little bit less than probably a lot less than what the prepayment schedule is reads. So prepayment is probably one of the most important things we look at. And you'll see there's a couple different examples here. Starting at the end, the exit fee. So that's obvious. 0.5% exit fee. No matter when you exit it in their 3-year term, you're going to pay a 0.5 point exit fee. This bridge option, 24 months minimum interest. You start that loan, you go 1 month in, something great happens. You increase what the property is kicking off. You go to get them out of that loan. They say, yeah, no problem. You're paying us as if you had this for 24 months. Pay down schedules, 3-1-0-0-0, 3-1-0-0-0, 5-4-3-2-1. That's basically year 1, you would pay 3%. Year 2, you would pay 1%. Years 3, 4, and 5, it would be 0. And then yield maintenance. Yield maintenance is probably the most complicated form of prepayment. And yield maintenance is going to take into effect what the interest rate of the time you want to get out of the loan is. So that's yield maintenance. They're maintaining their yield. They're maintaining how much they're going to make on that money when it went out the door. So if you borrow money for 5 years and the interest rate were to drop in that 5 years, your yield maintenance would be very high to get out of that loan, because now they're getting that money back and they have to send it back out to someone else. But at that current time, the interest rate of the market is much lower. So when it goes back out to someone else, they're making less money on it. But the contrary, if you borrow money at 3% and you have a yield maintenance loan and loans go, and then the market goes up to 6% interest, when they get that money back, they're going to give it back to someone else and be making 6. Your yield maintenance payment would be less. So it takes into account what the current market condition is. And then the rest is kind of standard. Origination fees, usually 1%. You see that all the time. And estimated closing timeline, that's usually just a guess. That changes all over. And the general comments are usually BS as well. So you just want to, you're basically focusing on this top section, and probably the most important thing for us is the prepayment. Do not mess around with that number, especially if you're looking to get out of the loan, which in real estate, our main goal is to buy the deal with money that we need to buy the deal, and then we want to move on. We want to get our money back and do something else. Let's see if I have another slide here. I think I might, maybe not. Yeah, so I think that's it. We hit a lot of topics here. Let's see, just stop sharing here. Hold on. Yeah, so we hit a lot of topics. Is there anything in the chat that we have to hit? I haven't been looking at it. Or anyone have any questions? Raise your hand. We'll hit it.
Yeah, we're happy to talk about any debt options. And again, if you have a smaller project you've considered, you've been thinking about kicking the can around, we're happy to give feedback on how lenders may be looking at today, who we think may be a good fit, and really get some of those terms that Chris outlined for your project specifically. You know, don't hesitate to reach out.
Yeah. All right. Jason, I got to say, that's an impressive office, man. It is nice.
I saw that too. That was beautiful.
It doesn't go unnoticed, that's for sure. Where do we feel the current opportunities are in the multifamily market? There almost are none. There almost are none. So we shifted, and like I said, we said in the beginning of the call, we basically shifted our attention elsewhere. Every single deal that comes across our plate, because we play in the 100+ category. So all the deals we're looking at are 100+ units. You're in a little bit more sophisticated of a world there. So your sellers typically aren't just your mom and pop own a 100-unit building and, you know, that's all they kind of do. The sellers that we talk to typically own hundreds and hundreds, if not thousands of units. So in the 100+ category, you're not going to get someone on the phone and say, hey, first of all, these sellers are being called 10 times a day. I've spoken to sellers and it's almost laughable how much their office phone rings of someone looking to buy. So, and it's usually brokers and then once in a while, direct buyers. So a lot of stuff is coming when it's ready to hit the market, it hits the market through a broker. People aren't, for the most part, people aren't interested in selling to someone without it hitting the market. You know, if you were a seller, why would you want your deal to just go to somebody? You want it to go through the marketing. You know, people, when they're messing with this kind of real estate, everyone is here to make money. So in the single family house world, you're going to hit more emotion, right? So you're going to hit someone just wants to get out of the house, or they're not interested in showing it because they might think that the house might be a little too messy to show and no one wants to buy it. You know, I've seen deals happen in that world, but when you get to the 100+ category, so really, I guess to answer the question, where's the opportunity in multifamily now? It's probably the below 100 market where there are mom and pop. That's a better answer. The opportunity is in the below 100. So probably 30 to 50 to 60 unit is where you're going to see your opportunity. And other asset classes is really the answer. So whether it be land or 68 unit, Hunter. So land is where Alex and I are playing. Industrial is so hot. It's going to be tough to get into there. Retail and office, if you could stomach it, there's possibly, and I'm saying possibly, do not attach my name to saying to put your money into retail or office. But I mean, if you've ever listened to anyone successful, very successful, they are all about buying stuff when it's the absolute worst time to buy it. So, that's a little bit beyond my risk tolerance, office. And retail, I don't think retail is dead. Retail is going to make a pivot. But if you get retail in real hot spots, there's retail in real good spots is safe. Retail in what you would consider like off the beaten path, maybe you always saw vacancies kind of floating through. There's going to be more and more vacancies in those spots. So real hot retail, I think, is safe. Office, just one thing about office, and Alex and I were out to eat with one of our investors. Was that last week?
Yeah, last week.
He brought up a good point. He actually lives in Manhattan, and he was talking to some of his buddies that have Manhattan real estate. What they're seeing is companies that were absorbing 10,000 square foot office spaces, 100,000 square foot office spaces. What they're doing is they're minimizing their footprint in areas like Manhattan. Just call it where the big cities, they're minimizing their footprint and they're doing satellite offices. So they'll change their footprint in Manhattan from 100,000 feet to 25,000 feet. Then they'll go to Red Bank, which is a local area, New Jersey. They'll get 10,000 feet there and a couple different 10,000 foot spots, just so people don't have to travel. People are going into the office less. So to minimize the complaints of traveling or commuting, they're creating more office, and it's going to create opportunity in the markets that might not have seen 100% occupancy because people wanted that footprint in the big city. The smaller emerging markets would actually see a little bit of a boost. So, if you have the risk tolerance for that, that might be some opportunity. But where Alex and I are sticking to housing, and we're just going to build it. And baby boomers looking to get out. There's an opportunity there nationwide in every industry. You couldn't even imagine the opportunity in this country always with people who are looking to retire. People looking to retire is probably the biggest opportunity nationwide in every single industry, asset class, everything. There's a wonderful opportunity with people who want to retire, even in business. You know how hard it is to start a business from scratch? It's significantly easier to take a business that's operating maybe a little bit shitty, that's already moving a little bit with some good employees, with just a weak driver behind the steering wheel. It is so much easier to operate that business and continue and to pick that business up than it is to start a business from dead scratch. So you'd be surprised of what you're going to see with people who want to retire. They're not, a lot of people you'll hear, oh, my business isn't sellable. My business isn't sellable. You'll hear, I was in the remodeling business. Everyone in the remodeling business says that their business isn't sellable. But if you're looking to get into the remodeling world, would you want to start a remodeling business that no one's ever heard of? You incorporated the company yesterday and you're going to start putting posters out and you want to try to build a reputation? Or a guy who's been in the remodeling business forever, he's just tired of it, which happens in the remodeling business. He's just tired of it. And he has a book of business. He has a good name. The name is well known, the name of the company. I would pay that guy a couple bucks to get in his business and just continue it. The phone's already ringing. And sure, you could buy that business and you could screw it up overnight. But it is definitely better to get involved in a business that's already put the energy forth to get that phone ringing. So the amount of people out there that want to retire, the opportunity lies in them. So whether it be real estate or anything else, be searching for, if you're thinking about starting a business, my opinion is search for that industry that you want to be in, of people looking to get out. and you'll find a tremendous amount of opportunity there. And very specifically, look at that business and see who hasn't implemented technology to the fullest extent. We take text messaging, social media, everything for granted. There are so many people who aren't doing so much of that. Just take businesses that haven't really implemented that. They don't think their business is too sellable, and buy that business, implement all new technology, and you'll see it would be significantly easier than starting a business from scratch. So retired people, not only in real estate, but everything, is a wonderful place to start. And a lot of times, if a guy doesn't think his business is sellable, he's thinking about retiring and just closing his doors. That guy would be extremely interested in seller financing his business. And I know this is not a business podcast or Zoom or whatever it is, but if you go to that guy and he's like, I'm just going to retire, I'm going to let my employees go. You go to that guy and say, hey man, don't do anything. Don't close. I'm going to give you whatever the business is making, but a fraction. I'm going to give you 10 grand a month to just let everything be. And I'm going to jump into your seat. I'm going to be in control. I'm going to take your infrastructure and employees and carry it forward. That guy would kiss you on the mouth, because he was 10 minutes ago thinking about closing his doors. And now he's going to get 10 grand a month passive income for something that he was thinking about getting out of. So yeah, retired people, target them. It would work for everybody. Works for you and it works for them. So yeah. The largest population in the country right now is millennials. So so baby boomers, just people who are retiring. It's time for the new generations are moving in, and the old gens are looking to chill out. Let them do it. Anything else? All right, guys, thanks for jumping on again. Be careful soliciting IRAs. Yeah. Whatever. IRAs are they're a good option. IRAs are a good option. IRAs are it's a wonderful way to get into certain things that you think you could. IRAs, people think that they could only put them into stocks. That's just the natural thought. IRAs, stocks, people don't realize they could pull. Yeah, the calls every Monday, Jake. People think that IRAs are just stock portals or stock vehicles. And really, you could do so much with an IRA. You could loan money. And Jason could take money out of his IRA and loan it to me for an interest rate, and I could pay him back to his IRA. And it stays within the IRA. It's the IRAs are highly underutilized. You could do so much with an IRA. Anthony and I, yeah, you could invest in real estate with an IRA. Anthony and I were on a flight from Florida to Texas and probably took up half the flight talking about what you could do with IRAs, and just it's endless. Anthony, I'll let him speak if he wanted to.
Yeah, sure. I'll give you a little bit of input. It's a great way to push your capital gains down the road. It works, I guess it would work similar to a 1031. However, the rental income is also tax deferred if it's traditional, and it's tax free if it's Roth. So if you can manage to get a self-directed IRA as your vehicle to purchase property, you can push the taxes down the road a long way. It's a great way to purchase real estate. Just be aware that it's only tax-free on the portion where your IRA is the equity. If you finance the property, you do have to pay tax on the finance percentage of the property. So just be aware of that. Some people miss that and it gets them into trouble.
Yeah. So just understanding it, but yeah, absolutely. And listen, taxes, they're inevitable. We want to push them. We want to keep pushing them down the road, because the money will grow quicker. The larger numbers grow quicker.
The
I'd
more
rather
taxes
pay.
you pay, the more money you can borrow.
Oh, what was that?
I said, the more taxes you pay, the more money you can borrow.
That's true too. That's true as well. I've convinced, I've had some friends, when I first started, they're like, oh, I get my rent in cash. I'm like, cash is annoying to me because then we got to bring it to the bank and deposit it. They're like, why wouldn't you just keep it? Like, if you have a 2-family house and you're collecting your rent cash and you're putting it in your pocket, your real estate career is over. You're stopping right there. You want that money in, you want to claim it all. It's the only way that you're going to progress in your career. Hiding money doesn't work. It's just a big, it's such a small-minded thing. I know that's not what he was talking about, but he basically, that's what he's talking about. The more taxes you pay, the more money you can borrow. You want to show that income. Just anyone on the call, don't ever get caught up in the idea of, starting out in this business and thinking that taking rental income and putting it in your pocket is a good idea. It's, besides from being illegal, that's a whole separate topic. You want to show that income, you pay the tax on it, and they'll let you borrow more money when you show that. So we think big, we don't think small. So, all right. Sounds good, guys. Thanks for jumping on. Hope you got something out of it. And yep, calls every Monday. See you next Monday.
Thanks, guys.